Good morning, investors. All right, so I'm resuming the Boeing position, and what I'm going to be doing is doing a live trade with you guys within this video to show you how I'm closing this long, or actually the short call, and then I'm going to reestablish another contract. Today, Boeing, it's up 2 points, but it's going down. So the short is going in the profit now, and the long is now in the red. But that's all right. It's not going to get called away from me. Remember, I have 568 days to work this thing. It's literally similar to going out and buying a $2,000 car, for example. And then within that amount of time, you can either rent it out, whatever you got to do to be able to pay that thing off, or the market has to go up and the automobile industry has to become inflated, and then you get to sell that car for higher than you paid for it. That's always the end goal when it comes to investing. So what these options are, or the strategy with options, the only thing that makes things a little bit difficult is for the fact that they have to go your way within the contract period, and they do expire. Instead of holding on to a car, selling it whenever, you determine the amount of days or the years that you're controlling this contract with a little bit less capital, and then you're using certain strategies like the poor man's covered call to sell against it to make the money back up. So you're using your money to work for you and not just playing a guessing game when it comes to buying stocks and hoping they go up, and then you're wondering, well, how far will they go up? So with this being said, I explained that in this position, it originally cost me $9,570 for the 110 call. And we had placed that on June 23rd at 9:54. I've made money by selling calls against it. And then when the Boeing dropped, I got to buy those contracts back for cheaper, and that's why you're seeing this profit. So I sold this for $1,100. It's lost value, and I get to buy it back for, well, what you're seeing for $117 right now in all profit. So the reason for this, I wanted to do an actual live trade with you to show you how to basically set up the order, to close it, and then reestablish and kind of understand my thinking as to which strike price to pick and how many days out. Could Boeing continue to drop? I'm looking at the 1 minute chart. We had news that the stocks rally into Independence Day as payroll surge ahead of predictions for June. We understand that there were jobs that got basically reestablished, so the unemployment rate had lessened. So that's good. But Boeing, remember, is taking an initial hit on the overall impact of this COVID issue, and also some flight issues and maintenance mechanics that they're having in their control panels. So with that being said, I'm going to go ahead and just pick up profit since it is giving me $117 today. I could wait it out for the full 50 days and make the 1120, but I actually was looking at the options chain, and within about 22 days, my break even has lowered for the fact that I did pay this thing off. And how you get your break evens is, remember, the 110 difference between the 205 is going to give you a certain amount. When you buy this contract, you have to add it on to here. So you do the math by taking the 110, and we're messing with 100 shares. Every one option contract is theoretically 100 shares, and then you have to add what you pay, or that debit, for the option contract. And then you divide by 100 is going to give us the 205. So this is the break-even strike price that I have to at least that's my strategy, that I want to sell a call. Because if this thing inflates up to 205.90, 206, 207, guess what? Again, TD Ameritrade is going to assign me the 100 shares at 110, and then sell them to the person that bought this contract, that I sold that contract to promise them that I would give them 100 shares at 205. It would take the difference. So if we do the 205 times 100 right? Gives us 20,500. Subtract the 110. That's going to be off, sorry. So let's back up for a second. 110 times 100 is going to give us 11,000. So we take the 20,500, subtract the 11,000, and gives us the 9,500. So the options are priced almost perfect when it comes to determining the strike prices of playing the difference. So as you can see, in order to get into this contract, to mess with a car that is valued at $2,000 and you want to resell it for $4,000 in a given amount of time, you have to pay for that, and it's exactly priced just right. So if we was to take that same example, a car that let's say at a longer period of time would cost $2,000 and it may be worth $3,000, and you want to sell it for $4,000, you have to pay for that contract, and it's going to be the difference in between the two strike prices. So anyways, I'm closing this out. I would right click it, close the order, and I want to go up all the way to the actually I want to lower it. I want to buy this thing cheaper than the market's giving me. The market will naturally and give you the natural price. You want to go down to the mid, you can go under to 10 even, hit confirm and send, and I'm going to put it in there to be able to buy this thing back. So as you can see right now, it's priced at 10.225. I'm going to try to get this to close for you. I'm not going to be too picky here. See if this thing will actually work in our favor to get it to close. And it just did. Okay, so I made profit there. Now what I'm going to do, I was explaining that I was in that for 50 more days and I can make $11.20 for full price. But why wait the full 50 when I'm looking at these options chain and these expiration periods 29 days out, and I can make $700-800 here in almost 20 days sooner. So $300 or $400 less, but 20 days sooner. So what I'm going to do is I'm going to look at, and remember, theta, which is time decay, these options actually start devaluing even faster around the 30-day mark. At 30 days, that drop-off curve, and I taught this in my stock options course, that there's what we call theta. You can buy this back cheaper within 30 days. So after the 30-day mark, that's why I like to sell options within 45 to 30 days because of that theta. So we can buy it back a lot cheaper and just keep scalping or hedging into positions more and more. So 36 days at the 197, I'm going to make 900. I'm going to try to get this for 1065. So I'm going to scroll this up. I'm going to go to, let's just say 1050. I'm going to make $1,050 on this contract in 36 days. The stock has to go up to 197. My break even's around 203, so that's going to shave about anywhere from $300 to $600 off. Worst case scenario, if this thing goes all the way up past 197.5 to 198, I still make $400. We got to subtract what I'm going to lose out on the two strike prices. If that doesn't make sense, message and I'll explain that a little bit more. But I'm lowering my cost basis or my break-even prices because I had already done this position about 3 different times and I made money on it. So the more I make, my break-even comes down less. I can get out of this thing at a lower strike price. So 200, 197. Actually, let me go to the 197. I'm gonna try to pick this up for 980. I did see a 980 buy there. Well, I can actually change that to 1,000 even. Hit confirm and send. And let's see if we get this thing. Right now it's priced at 9.22. If Boeing happens to pop up just a little bit, this contract will work in my favor and I'll get it at that price. And the reason I can get it at that price is because as the strike price goes up, these options here become up higher in this chain, so they become deeper in the money. So they're going to get deeper and deeper. As you can see, when it starts, say Boeing goes this way, well, guess what? Everything that was below that price starts becoming even more valuable to obtain or sell, because now you're deeper in the money. There's less chance for Boeing to drop to those levels. Let's just see what we're selling at. 917 right now, 920. Take a look at the 43-day chart or pattern right here. I can sell right at 1,000. But here's something to pay attention to. Your open interest, there's no positions open and there's no trading volume here. So within 36 days, there's a lot of volume, and anything below the 36 days. There is some volume right past that. If we do the correlation, or we think about this, why isn't anything happening after around the 46-day mark? We take a look at our daily. There's an earnings call that's in 20 days, so on the 22nd. What's happening out here? Is there some news or some something that's going on? It is the late quarter, so maybe people are not jumping in at the last quarter and waiting until the yearly mark. Who really knows? So that's also something to think about. There's no volume in the 43-day mark. The options are priced good here, but there's just no volume. So I'm going to try to play 36 and pick this thing up. I can sit here and put a good till cancel order in, and that means until this price hits, it's going to stay here. But then as Boeing climbs up, then I can actually sell this at the same strike price or even more. But today, July 2nd, with 36 days out, I can sell it for 1,000. So I'm trying to get this. I'm going to just do a 950 just to go ahead and get this to show you for a live trade purpose. Now I did make 315 plus the 100. So 415 plus 900 gives about 1350 divided by 95.70. A 13.7% return. So not too bad within a little over a month. So I'm going to go ahead and just get this. I'm going to try to drop it down to 915. That's the natural. It should go through. There we go. So it just sold for 915. So if the Boeing does not go up to 200, I'll take in the 915 in profit for sure, pretty much regardless. Even if it goes all the way up to 205, I make the 915. I'm going to have to subtract the difference in the 110 and 200. However, I made the money on the back end, about $300. So I'm technically lowering my break even here, and that's about right, around the 200 strike price. So that $915, right click, view trades, is pure profit. So this thing's going to expire in 36 days, a little over a month, and I'll pick up $900. So even without any of the other positions that I had made money on or the other contracts on this same strategy right here, 915 divided by 95.70 gives us a 9.5% return. So there you go, guys. I'm showing you all the time, every day, all day, hopefully more and more often, how to do these setups, why your financial advisor is making the kind of money that they are. However, anyone can really do this. The stock options world, there is a little bit more leverage. There is a lot more risk for the fact that it's the way you take over these assets. But remember, if you know how to, for instance, if you do take over the assets, learn how to control them in your favor and resort to the options market world. That's it for now. I hope you pretty much learned how to do the poor man's covered call on Boeing. This one is one of my favorites personally for the fact that premiums are generally high. Boeing does move pretty volatile, but remember, it is a government-backed asset and stock, and I like the premiums. Just learn how to trade Boeing. If you got any questions, definitely reach out. Make sure you're basically doing the simulated trading before you ever get into the real money. And then, yeah, just gain all the information that you can about stock options before you do it. Do about 2 years worth of paper trading. If not, at least make sure you're fully aware of how options work and how they're valued. So anyways, investingwithchris.com, investingondemand.com, and I'll see you next time.